If you only look at the headline numbers, the U.S. economy looks unstoppable right now. Tech companies are pulling in massive amounts of cash, with Nvidia recently reporting $96.22 billion in second quarter revenue. The job market also looks stable on paper. The national unemployment rate is sitting at 4.1%, and the initial shock of previous years seems to have leveled off. But these flashy numbers are hiding a quiet financial threat building right beneath the surface. The Federal Reserve is facing a situation with very few clear exits. They are staring down sticky inflation and a slowing labor market, leaving them with no safe moves regarding interest rates. A booming stock index creates a powerful illusion of safety. However, the data suggests that a rising market and a safe economy are currently two very different things. To understand the pressure the Fed is under, we have to look at how inflation is behaving compared to their specific goals. While the pace of price increases has cooled, the actual prices for basic necessities are still climbing. This chart shows the PCE price index, one of the specific inflation metrics the Federal Reserve watches most closely. It hit 3.7% year-over-year in July, which was higher than most estimates. This creates a significant gap between reality and the Fed's long-term target of 2%. The sectors keeping that number elevated aren't luxury goods. Auto prices, housing, and utility costs, the unavoidable daily expenses, are stubbornly refusing to drop. Because these costs remain high, the Federal Reserve is effectively paralyzed. They cannot declare victory over inflation while the average household budget is still under this much heavy pressure. This brings us to the Federal Reserve's current holding pattern. At their July meeting, the Fed kept the target interest rate between 3.5 and 3.75%, but that decision was highly contested behind closed doors. 3 members of the Federal Open Market Committee actually dissented, pushing for a rate increase instead of a pause. All eyes are now on Federal Reserve Chair Kevin Warsh, heading into Jackson Hole. Wall Street is hanging on his every word, knowing that a single sentence about monetary policy can move trillions of dollars across global markets. The labor market adds another layer of complexity. While initial unemployment claims remain relatively low at 203,000, overall corporate hiring has visibly slowed down. This creates a brutal tightrope for policymakers. If they cut rates to encourage hiring, they risk reigniting those sticky price pressures. If they keep rates high to crush inflation, they risk a deeper contraction in jobs. This tightrope leaves little room for error. A single move to protect the job market now risks a new surge in prices, while staying the course could force more aggressive layoffs across the country. Despite restrictive interest rates and a divided Fed, major indices have remained buoyant because investor capital is concentrating in a specific pocket: artificial intelligence. A tiny handful of mega-cap technology companies, giants like Nvidia, Salesforce, and CrowdStrike, are posting massive earnings. Their sheer size is generating enough optimism to drag the entire market index upward. This creates concentration risk. It happens when the apparent success of an entire market relies almost entirely on the performance of just a few stocks, masking weakness everywhere else. If those specific AI companies experience an earnings disappointment, or if high interest rates finally crush the valuations of these growth stocks, that surface-level optimism could disappear quickly. Everyday investors are trapped right in the middle of this tug-of-war, caught between AI-fueled market optimism on one side and the reality of inflation on the other. Navigating this environment requires a shift in strategy. First, stop building your personal financial plans around predicting the Federal Reserve's next move, as rates and forecasts change too quickly to be a reliable foundation. Second, prioritize the elimination of high-interest debt. Because interest rates are remaining restrictive for the foreseeable future, carrying those balances is becoming exponentially more expensive. Third, audit your investment portfolio. Ensure you are diversified across different sectors, rather than just holding a cluster of tech stocks tied to the AI boom. It is a mistake to view a market reaching new highs as a risk-free environment. Uncertainty is increasing even while indices are moving up. Financial safety requires looking past the daily ticker to see how inflation, employment, and corporate earnings actually intersect. Understanding those specific forces is the only way to protect your money from the collision ahead.